Inflation. You hear that word on the news all the time, right? But what does it actually mean for your wallet? For the money you're trying to save? Today, we're going to pull back the curtain on this powerful, kinda invisible force that's shaping our financial lives every single day. Okay, picture this. You've been working hard, saving up for weeks for those awesome $50 sneakers you've had your eye on. You finally get the cash together, you head to the store, and the price tag now says $55. It's just so frustrating, isn't it? It feels like your money just isn't worth what it used to be. So what is going on?
Well, that feeling, that's inflation. It's this thing that makes prices creep up over time, and it basically means your hard-earned money buys a little less today than it did yesterday. And it's not just about sneakers. It hits the cost of your food, gas for your car, your rent, pretty much everything.
So, okay, how does this even happen? To really get to the bottom of it, we've got to pop the hood on the economy and look at the one simple rule that drives every single price you see: supply and demand.
It's actually a really simple idea, but it's super powerful. When there's not much of something and everybody wants it, like, that hot new game console that's sold out everywhere, yeah, prices go through the roof. On the flip side, when there's a ton of something and not many people are buying, think about a farmer's market at closing time with piles of apples left. Prices have to come down. And look, this isn't just about fun stuff like games or apples. It's the exact same principle that makes car prices go wild when there's a computer chip shortage, or that makes housing so expensive when there just aren't enough homes to go around. It even affects how much you get paid. It is literally everywhere.
Okay, so if supply and demand is the engine, what's actually pushing the gas pedal and causing inflation across the whole economy? Well, economists usually talk about two main flavors that explain why everything starts getting more expensive.
First up, you've got something called demand pull inflation. This happens when the economy is really humming along. People are feeling good about their jobs, they're spending money, maybe getting a loan is super cheap, and all of a sudden it feels like everybody wants to buy stuff. The problem is there isn't enough stuff being made to keep up. That's the classic too much money chasing too few goods, and it literally pulls prices upward.
All right, the other flavor is what's called cost push inflation. Let's go back to those sneakers for a second. Imagine the cost of the rubber for the soles or the leather for the upper just shoots up. Or maybe the workers at the factory get a big pay raise. Well, now it costs the company more to make each pair of shoes, right? So they have no choice but to push those extra costs onto you, the buyer, by raising the price.
So you've got prices getting pulled up by all this demand and pushed up by rising costs. It can really feel like things are getting out of control. It makes you wonder, right? Is anyone actually steering this thing? And the answer is, yeah, someone is. That's the whole job of a country's central bank. Think of the US Federal Reserve or the Reserve Bank of Australia. Now, here's a twist that might surprise you. The goal isn't to have zero inflation. Believe it or not, a little bit of it is actually seen as a good thing. They're usually aiming for a low, stable rate, something around 2%. That's considered the sweet spot. Why? Because it keeps the economy growing at a healthy pace and lets businesses and people like you and me plan for the future without having to worry about crazy, unpredictable price jumps.
So how do they pull this off? Well, their number one tool is something called the policy interest rate. You can think of it like a master control dial for the whole economy. When the central bank adjusts that dial, even just a little, it kicks off this massive ripple effect. Commercial banks see it and change their rates on your car loan, your mortgage, even the interest you earn in your savings account. And that changes our behavior. Do we spend or do we save? And that is what ultimately steers inflation. The easiest way to think about all this is to imagine the central bank is driving a car. They're constantly making tiny adjustments, moving their foot between the gas pedal and the brake pedal to keep the economy moving along just right. So if the economy feels a bit sluggish, they'll press the gas pedal. They do that by lowering interest rates. That makes it cheaper to borrow money, which encourages all of us to spend and businesses to invest. But if things get too hot, if those sneaker prices are climbing way too fast, they tap the brake. They raise interest rates. Suddenly, saving your money looks a lot more attractive, and taking out a loan is more expensive. That cools spending down. So what about that perfect state, when you're not hitting the gas or the brake, you're just cruising? Well, in economics, that's called the neutral rate. It's this theoretical sweet spot where policy is neither speeding the economy up nor slowing it down. It's perfectly balanced. And honestly, finding that Goldilocks rate is the billion-dollar question for central bankers. So where does that leave us right now? Let's take a look. You can see here the estimated neutral rate is about 1%, but the actual policy rate is up at 2.25%. So what does that tell you? The foot is definitely on the brake. This is what's called a restrictive policy, and it's a deliberate move to slow things down. For us, that means things like mortgage rates get more expensive. But on the flip side, the interest you earn on savings goes up. It's all part of the game plan to get inflation under control.
And if you ever hear on the news that the central bank is normalizing its policy, this is exactly what they're talking about. They're not slamming their foot from the brake to the gas or vice versa. They're just gently easing up, letting that policy rate drift back towards that neutral, balanced spot.
So, to wrap it all up, the central bank has this powerful toolkit, a gas pedal and a brake, to try and steer our economy and keep inflation stable. But here's a final thought to leave you with. In our crazy, interconnected world today, with supply chains that wrap around the planet and money that moves in a blink, is the central bank really the only one with their hands on the wheel?